This is the current federal tax developments for the week of April the 21st, 2025. Current federal tax developments are brought to you by your state society of CPAs. From here in Phoenix, I'm Ed Zollers, and we're going to talk this week about what's been going on in the area of federal taxes. And we've had a few things happen this week. First up, we're going to talk about the question of can we equitably basically extend the 90-day deadline for an employment tax redetermination? And if we can, did the taxpayer in Belagio Fine Jewelry actually have a case that would allow us to go there? Secondly, we're going to look at substance over form and nuances of various tax elections for disregarded entities in what had been apparently a marketed tax plan that was put into play by Deutsche Bank and for client, in this case, GWA LLC. We'll talk about both what they were trying to do, what the IRS didn't like about what they were trying to do, and how the court reacted to that. We'll also have this week Notice 2025-23, where Treasury and the IRS have now signaled they are going to withdraw the basis shifting TOI regulations, transfer of interest regulations, and related penalties. Those have been established in January of 24. Those regs came out as final. There had been a lot of complaints about those regs, potentially requiring a lot of reporting and treating as transactions of interest, transactions that are really very standard business transactions, nothing that had a tax evasion purpose behind it. And apparently the IRS has now decided with the change in administrations to back down on that. And finally, we're going to look at a hobby loss. We haven't looked at a horse case in a while. We're going to look at the case of Himmel versus Commissioner, and the question of what are the issues, how do you determine if you have a hobby loss? And also, another question that came in that case was what exactly would be reasonable cause for failure to file a return? And I'll give away the plot a little bit ahead of time. It's definitely not what Himmel did. Himmel started down the right path. They just didn't tie up things the way you need to do. You have that. Theoretically, either one of the things they talked about for, excusing failure to file, that started out the right place, as we'll discover. The problem is they didn't hook those things to specifically why they filed late. So we'll talk a little bit about that. So let's start out and let's talk about the 90-day deadline for going to tax court for employment tax redeterminations. This is the Belagio Fine Jewelry Inc. case and equitable tolling. And the two key questions here is it available if you have a employment tax redetermination case, you go to tax court and you're late filing a 90-day petition? And secondly, if it is available, were the facts in Belagio going to be ones the court would find would allow for equitable tolling? So let's talk a little bit about where this goes. Now, on August 24, 2021, and I should say that this is 164 Tax Court Case Number 7, 2025. Important to point out, this is a published case because this is the first time the tax court has told us if there is equitable tolling on this issue. So we had this August 21st, 2021 employment tax redetermination. It was for the 26 and 2017 tax years. They determined the employee status and assessed deficiencies, addition to tax, and penalties to the IRS. Now, the explicit 90-day deadline to file a tax court petition was November 22nd, 2021. In this case, the petition was mailed via FedEx Express Saver by staff at the law firm, but not by the attorney in charge of the case. As we will discover, FedEx Express Saver is not an approved private delivery service. Remember, it has to be a specific service with FedEx, not just using FedEx. And the big problem that came out, using that wasn't fatal since they did it on November 18th, except it didn't arrive till the 23rd. And if you use a non-approved delivery service, you don't do it with certified mail, registered mail, or an approved PDS, then actual date of delivery will be the date in question. So on paper, they're 1 day late. November 23rd was 1 day after the last day their petition had to be at the tax court, or if they'd used a private delivery service that was approved or sent it certified or registered mail, if they basically had turned the document over that day using the proper service. Now, the IRS noticed this issue and filed an initial motion to dismiss, right, by the IRS. And they said, look, they missed a 90-day deadline, game, set, match, we're done. The tax court had denied that initial motion to dismiss. They held that the 90-day deadline is non-jurisdictional, right? Claims processing rule. So this was in a prior ruling in Belagio in 2024. So they're saying, okay, this is non-jurisdictional, which means, as we'll discuss, that if you have a good enough reason and equities argue in favor of granting you the ability to file slightly late, then you could get away with the late filing. The question we've got is, how did it work in this case? Now, subsequent motion by the IRS argued the 90-day deadline is not subject to equitable tolling or not warranted in this case. We'll discover that the tax court is going to disagree on the first one, but they are going to agree on the second. Now, generally, and this comes from the Batchelor case that was from the Supreme Court in 2022, non-jurisdictional deadlines are presumptively subject to equitable tolling. The ideal concept here is that you need to show a reason why the deadline should be read as a strict deadline, not a deadline that's there, but if there's good enough facts behind you, you can get essentially excused for having filed late. Now, the deadline in section 7436B2, which is the one for filing when you have a question about employment taxes and you're filing in the tax court, which of course has the advantage of not needing to pay the tax before you do the challenge, because otherwise you got to go to district court or the court of claims. The court found that's not an unusual emphatic form or a highly detailed technical matter like the refund claim deadline in IRC section 6511, which was, brought up in the Bucamp case in 1997. Those are the key tests. Remember, generally, the Supreme Court said we're going to assume equitable relief is available unless Congress is emphatic on the fact that you got to file by this date or it's all over, or there is a highly detailed technical issue in front of us, and that means we need to be very strictly filing the dates. So the court concluded that the presumption in favor of equitable tolling was not rebutted in this case, and therefore the court said, good, if you can make the case, in this case, if you can make the case, Belagio, that equitable tolling should apply given your facts, then, we'll go ahead and let you file this a day late. So bottom line, the key first ruling is a 90-day deadline for challenging a payroll tax assessment in tax court or payroll tax, payroll classification ruling at 7436B2 is subject to equitable tolling. And the tax court said 3 key reasons here why it is. The deadline is purely procedural. It's not tied to substantive rights. The statute lacks any express prohibition of equitable tolling, and it's not itself highly detailed, suggesting that if there's lots of exceptions listed, then the court will say, look, if Congress said the deadline is this date, but if you meet any of these 6 exceptions, then, we'll let you file late. That would seem to indicate that having enumerated a bunch of specific exceptions, that's because just general purpose exceptions won't cover it. Didn't have that in this case. And there's a very limited number of petitions filed under this every year, not a whole lot of challenges to payroll tax classifications or payroll classifications. So the court found that it wouldn't impose a huge administrative burden on the courts to allow these cases to come in under equitable tolling if there was a reasonable reason why it made sense to grant equitable tolling in the case. But the question in this case now is, does the taxpayer have a reasonable, reason here that is enough to allow the court, the court's going to say, yeah, we're going to grant relief in this case. And there are 2-pronged tests the taxpayer must show to get equitable tolling. You got to pass both of them. If you fail either one, then you won't get equitable tolling. And the first test of this is the taxpayer must diligently pursue their rights. In essence, the taxpayer. must essentially go after and, be very, very much on top of getting things done and getting this thing filed on time. And that was the key. And it doesn't matter that the taxpayer just thought the attorney would take care of it. We'll talk a little bit about that. That's different. And then secondly, if in fact, despite the taxpayer diligently pursuing their rights, thing didn't get filed, you need to show there were extraordinary circumstances that was outside the control of the taxpayer that prevented timely filing. So on the first thing, on the failure to satisfy the first prong is in the court's ruling, there was no indication the actual taxpayer, Belagio, right, management there, was diligently following up with its attorneys to make double, triple sure that the petition got filed on time. Unlike in the case of Menominee Indian Tribe of Wisconsin versus U.S., that was a Supreme Court case in 2016 where the tribe was, diligently, following up to make sure this happened. They were on top of it. This case, Bellagio just, as a lot of taxpayers would, just presumed the attorney would handle it properly. They didn't actually keep checking. That was a negative here. And as the court said, that by itself would be enough to distinguish this case. But secondly, the second prong, were there extraordinary circumstances outside of the taxpayer's control that prevented timely filing? And the court held that negligence of your attorney's staff, if you're a taxpayer, in selecting a non-designated delivery service, in this case, FedEx Express Saver, is simply garden variety negligence. And the taxpayer, you picked an attorney who, the attorney's negligence is going to count against you. And that's, so you can't say my attorney screwed up in that realm, or at least not this way. This is garden variety negligence where they just simply, it wasn't that they misinterpreted the law, because that can actually get you out. If the attorney gave you the wrong deadline because they looked at the law and made a mistake, that probably will get you some consideration here. But the catch here was, no, they knew the date. They knew they knew they were supposed to file. They even, thought they were doing the PDS, the private delivery service. The problem was that, the staff simply didn't understand the rules. And the attorney even admitted that had he filed that thing, he would have chose, the FedEx priority overnight, which is a qualified service. He wouldn't have. And I'm sure what happened here is that somebody looked at the price difference and decided, we're going to go with the cheapest one. Right, which was, the FedEx Express Saver. As you might guess, that emphasizes economy, and that's obviously what somebody probably selected based on. Now, it is true, you don't have to take the most expensive, but you do have to take one that's on the list. And our problem here is this one's not on the list. And the court ruled the client bears the risk of attorney negligence. It's your attorney, you should be supervising your attorney, and, your attorney's negligence in, handling this, you can't get out and get equitable relief because of that. Where it said, sorry, you chose the attorney fouled up. Effectively, the bottom line is, attorney, you probably want to call your malpractice carrier right now because, the client's going to have to at least put up the money now for the payroll tax assessment in order to pursue any refund claim in the district court, which is going to be a problem, assuming we still have a statute there. And this garden variety negligence is, the court cited Irwin, versus Department of Veterans Affairs, another Supreme Court case from 1990. Now, what should we worry about as tax practitioners? And I realize that most of you probably don't file tax court petitions, right? So again, that part of it, not correct, not really there entirely. But what is important, though, is that we do have situations where we may be doing things, filing documents, because filing tax returns is there. Number one thing is, regardless of whether or not you think there might be, relief there in terms of being able to, get equitable relief for late filing, it's still way better to ensure that you actually are treated as having filed the return before that date. there's, in essence, we don't want to go and hope we can prove equitable relief, even if equitable relief is available. Obviously, if it's fouled up and, it went in late and it's clearly going to be late, then yeah, we're going to try to argue equitable relief. But you never want to go in, kind of depending on. In fact, as a practical matter, if you were depending on equitable relief and you figured it doesn't matter, we can file this late, that's probably going to be, game, set, match for the IRS in showing that no, they didn't reasonably try to follow the law. Make sure you use proper mailing procedures. You want to use the United States Postal Service, right? Certified mail or registered mail, which is, the code says that, when you have the little white receipt there, and that's really the key, it's got to be the white receipt where the postmark date is stamped on it by a U.S. Postal Service employee. And by the way, the reg has all of that in it. So no, you cannot go to a UPS store and have the person behind the counter at the UPS store, basically, say, oh, yeah, we'll mail that certified for you. We had a case a number of years ago that we covered here where taxpayer did that, and, the UPS store just didn't take the mail to the post office that day. So the actual certified mail and the little receipt the UPS store had was a day late. So that was a problem. The approved private delivery services are found in IRS Notice 2016-30. You want to make sure it's there so we have proof of timely filing under Section 7502. Had they used an approved private delivery service, and as I recall from that list, they could have used just simply FedEx second day service. That I believe is the least expensive service from FedEx that will qualify. As I recall, the similar second day service from UPS qualifies as well. But you want to make sure it's on that list. Make sure you check that list. And the IRS does from time to time, although they haven't updated really for 9 years, update that list. So you want to make sure that you got the current list and you're using a service on there. And make sure, if you are not going in yourself to do this, make sure your staff understands that it's got to be one of these services. I know they're going to tell you at the FedEx store that, oh, well, this other one's cheaper and it'll get there basically the same time. No. Don't go for that. They may be trying to be helpful at the FedEx store when they tell you that, but it turns out very badly if you follow it. Make sure if you're a taxpayer, your clients should be following up and watching you. I mean, I know that's annoying. I know it's annoying when they're calling and saying, well, did you get, are you going to get my extension? Are you going to do that on time? Are you going to get this done? Nevertheless, the client, that actually protects the client as much as we may all hate it from time to time. Yes, I'm going to do that. Yes, I'm going to do that. Yes, right. In essence, that's there. And remember, even if equitable tolling is available, it's very limited. It requires demonstrating diligence and extraordinary circumstances that are beyond merely simple negligence. So, as I say, we don't want to rely on equitable tolling unless the situation is unfolded and we got no other option. And then you just sort of hope that you're going to convince a judge that this is a case where it applies. Next up, we're going to talk about GWA LLC versus Commissioner, Tax Court Memorandum Decision 2025-34, came down April the 16th. And this looks at the questions of substance over form on an arrangement that was put together for this LLC, which, as I recall, is a hedge fund. It was put together by their bank, Deutsche Bank, put it together for them. And, was it really what it claimed to be, or was it something different? And then, interesting question here about what they try to do as well in terms of making a mark-to-market election that they tried to have made by a disregarded entity, and then to argue that when the disregarded entity made the election, that it only covered the securities that were involved in the securities held by disregarded entity and didn't impact the other trading activities of the owner, which was GWA LLC. And, can you do that? Can a disregarded entity make an election that only is going to apply for an accounting method to the disregarded entity? So those are the two big questions we had in this case. So a little bit of background. We have the barrier contracts and IRS scrutiny of that transaction. So GWA LLC, a partnership, executed barrier contracts, and we'll talk about that discussion, what that is, with Deutsche Bank in the 2000. Now, they were structured as options on a basket of securities, right? The securities would be owned by Deutsche Bank, right? And theoretically, the partnership would have options. Now, the IRS identified similar transactions as abusive, and they concluded that Deutsche Bank helped hedge funds, including GWA, avoid taxes and leverage limits. So it was both a tax issue and it reduced the rules on leverage, where they exceeded excess leverage. It got around that by having this thing not owning these stocks, but having it simply be options and having Deutsche Bank on paper be the entity that owned the stock, the basket of securities. Now, the IRS issued under TEFRA, the final partnership administrative adjustments for 2009-2010, recharacterized the barrier contracts as essentially ownership of the basket of securities, which, as you might guess, is a bad thing, because if those any of the securities are traded, which happened during that time frame, the gain would be taxable. And there were some big gains here. They were trying to defer those gains by having this option wrapper around it. So this resulted, if they were treated as the owner of that basket, it would result in a lot of huge income adjustments and a lot of penalties. So, of course, GWA was going to court to fight this, because we're not talking about small money here. Now, the key issues the court was looking at were really four. First, we're going to look at the barrier contracts, which purport to be options held. So GWA held options, and that was it. Should that form be respected? Should GWA be able to treat this as simply ownership of these options? Or did the reality of the transaction, the economic substance, mean that really they were the owners of the underlying securities? They had the benefits and burdens of ownership. That's the first issue. Second issue was the validity of the mark-to-market election under 475F. Remember, under 475F, if you make the mark-to-market election, has one advantage as if you lose money, right? The loss will not be capital, it will be ordinary, right? And the other catch, though, is that you have to mark securities to market every year. Now, in this case, GWA put all of the securities, the basket securities transactions, were inside of a disregarded entity, an LLC that they owned 100%, OGI. So OGI held this, and OGI, the disregarded entity, is the one that made the election in 1998 to go to the mark-to-market system. Is that valid? Or because it's disregarded, did GWA have to make that election, which then means there may not be an election there? Third, assuming that the IRS determined that no election was made back in 1998, did the fact they went ahead and kept reporting as if it was a valid change, does this mean that's a method of accounting change when the IRS comes back and fixes it later? And must there be a 41A catch-up adjustment? That's the third issue. And the fourth issue is, assuming that there is tax due for any of these reasons or all of these reasons, did GWA's activity justify negligence and substantial understatement penalties, or should they be let out of the penalties? So these are the four key issues the court's looking at. Let's talk about substance over form. As was noted in Frank Lyon Company versus United States, a 1978 Supreme Court decision, substance, not form, govern tax consequences. There's no question that Deutsche Bank had legal title. But if legal title does not really give us the substance of the transaction, then may not matter, right? The real test under Frank Lyon, 1978 case, is the benefits and burdens test I mentioned already. Who had the benefits and burdens of ownership? Was it of that basket of securities? Was it GWA or was it Deutsche Bank? The court concluded it was GWA. Number one, GWA bore the risk and reward. If those securities went down, GWA had to cover the thing. And if those securities went up in value, they got to pocket the benefits. They're saying, so you were going to participate in the upper downside. Deutsche Bank was insulated. They had significant control over securities. They actually told Deutsche Bank how to vote some. They would tell them from time to time to, when to do a transaction to get rid of some, pick up new ones. So they're able to make those changes. And they could effectively access cash inside of that. So they had access to it if they wanted to. So based on all of that, the court concluded that these contracts lacked economic substance. And they did not have the economic or legal characteristics of real options. GWA was the owner of the basket of the securities for tax purposes, even if they weren't the one officially listed as the owner of the various securities. It didn't matter because they essentially had all the economic benefits, all the economic burdens would end up on GWA. So first issue, they own the securities. As already mentioned, that means there's a lot of unreported gains that are in play, or delayed gains, deferred gains that shouldn't have been deferred. So, okay, first court ruling, we have that. Next question. The mark-to-market election. Even if they were right there, if in fact they made a valid mark-to-market election, arguably we may have closed years, et cetera, if that's a valid method of accounting. Because, some of those gains, losses, et cetera, okay, they should have been reported in prior years, is what you'd be saying here, if this was a valid method of accounting. Now, GWA argued that OGI, the discard entity, was a person that was entitled to make the 475F election. This 475F says a person makes this election. For those who never made that election, it's got to be made by April 15th, effectively, for an individual. April 15th, March 15th, since this was a partnership, of the year in which you want the election to apply. So, hint, right now, for a calendar year taxpayer, it's too late to make the election for 25. Yeah, your deadline went away over a week ago. That was the deadline for an individual to make the mark-to-market election under 475F. The reason for that is there is a huge benefit if you could make it with hindsight. They want you to have to make the election before you know the results. Right, you're going to do that. But in this case, the court rejected activities of a discard entity are treated as those of its owner. And the court cited the McNamee versus Department of Treasury case from the Second Circuit in 2007. Right? The election that was purported to be made by OGI and limited to OGI securities, is not a valid election. A valid election had to apply to all of GWA's trading securities. GWA didn't want that. Right? They only wanted this set with the options that would be covered by this. And so the court said that was a impermissibly selective election. You can't do that. OGI can't make the election, and you can't use discard entity to limit the securities covered by this. And they said an attempted invalid election is treated as no election at all, citing a 1991 tax court decision in the case of Plum versus Commissioner. So there is no valid mark-to-market election. However, they've been recording things for quite a few years as if it was, that was the method they were using or how they were structuring. Now, the question becomes, is that a method or an error? Because if it's an error and not a method, right? And they never had permission to use this new method. So, are all those prior returns just errors? And IRS can only go after the last, the open 3 years? Or is this a method of accounting situation? And if it is, then they could use a 41A adjustment to pick up adjustments going back all the way to when they first started doing this wrong. So here's the question. The court went to the basic definition of what is a accounting method. And that looks at primarily accounting methods affect timing, but not the amount of income or deductions recognized. And the court found that in this case, the recharacterization by the IRS of this to the securities being held by GWA and no valid 475F election that was simply an improper method of accounting by GWA. And because it affected timing only, not, it's not just the wrong amount. It's an amount that eventually, and the way I always look at this is, if we follow this entity from the day it started, let's say until the day it shuts down, it would still cumulatively reported the same income under either of the methods, right? We're simply deferring a gain. If that's the case, then you're looking at accounting method because that's a timing issue. If instead you just report the wrong number, there was one a number of years ago we talked about on here, where a taxpayer literally was recording commissions paid, to salespeople, et cetera, that had to pay on sales. It accrued them and deducted them when they sold the product, and then it deducted them again when they paid it. That was held not to be an accounting method. That's a flat out error, right? And of course, the IRS wanted accounting method to be able to collect all the years before they caught this. The taxpayer obviously got hit with negligence because it's a little tough not to in that case. But the court did not. The court said, no, IRS, this is not an accounting method. This is a flat out error. It would never fix itself if they kept reporting this way. So basically, it's a change of accounting method, meaning 41A applies. 41A adjustment is going to be a downer because it's going to be fairly big. Now the question becomes, so they got this big check to write for the taxes, and of course interest, etc. The real question now is, are they also going to get hit with negligence penalties? Basically the misstatement penalty, substantial understatement, and negligence. And in this case, the court concluded for negligence that GWA failed to exercise due diligence, given they knew these were big financial implications. There were red flags about what was being done. You have to inquire beyond the party promoting the structure. They specifically cited the Neonatology Associates case from 2002, which has basically been, ever since it came out, the case the court will always point you to about, if this tax deal, this tax shelter sounds too good to be true, you can't just take the story from whoever's promoting it. You got to have independently confirm what they're telling you. And the court found that GWA simply, didn't pay much attention. They simply went along. They didn't do that sort of independent work from, and got the background to do it because they didn't want to ask questions. They wanted this to work. That's the concept, right? People don't tend to ask questions about things they want to work. And unfortunately, that's a real problem we have in a lot of areas these days, because this becomes in many ways too a form of confirmation bias. You only want to hear the opinions that support this, and anything you hear that doesn't, you just tune out. Yeah, that will get you into big trouble here, which is part of what happened here. It also had, the transaction they entered into lacked substantial authority, and they did not adequately disclose it. So because of that, they also had the substantial understatement penalty would apply, or the negligence penalty would apply. They're both going to basically be the same. And the penalties apply to underpayments that were attributed to the 41A adjustment. Try to argue 41A adjustment shouldn't count, right? Because that was like prior years. The court said, no, that's part of the year the adjustment gets made. That's underreported income because it should have been reported. You could have voluntarily changed your method by coming out, confessing, etc. Presumably, nope, sorry, you didn't do that. So what's the implication for those of us advising clients who probably aren't advising hedge funds the size of GWA? There's still important things here. Number one, substance over form is still very, very important, right? There's a critical importance of analyzing the economic realities of sophisticated transactions. And the problem is, in many cases, the taxpayer knows exactly what the substance is, right? In essence, normally, that one of the things that would be promoted, a lot of times in the materials that they hand out trying to get the client to do it, would be that, oh, GWA, you still have total control over this basket of securities. You're still really controlling it. You're not just having these option contracts, but you have control. In fact, they almost certainly negotiated for that sort of situation. You got to say, what's really happening here? You cannot rely solely on the technical papered stuff in most cases. You have to say, what's this? Is this the real transaction, or is this all a farce, effectively? Say it's kind of how the court will view it. That's meant to pretend we're doing X when we all know we're doing Y. So you have to be careful there. Discard entities in tax elections. Gang, don't assume a discard entity can make an election unless there's clear authority to do it. Generally, discard entities are just that, disregarded. They don't exist. As such, they can't make elections, right, for the owner's activity. Generally, if you have something in a discard entity, it will have to be the deemed owner. Any elections will be made by the deemed owner or the return on which everything's being reported, right? They try to get cute here and say, hey, we can just restrict it to this LLC, which is a legal entity. No question. It's not a tax entity. You have to look at the tax entities. Remember, too, that recharacterizations, you're looking at these things. 41A can reach all the way back decades to pick up income that you failed to report, or you didn't report, or that you're pushing forward, right? And that's really it. You're trying to defer. 41A can suddenly force all that deferral onto the return instantly. It turns out you shouldn't have been deferring. You should have been reporting it as you went. People get confused. 41A is not the statute of limitations is not a problem, because 41A says you basically have a catch up on the cumulative adjustment. And that goes into basically the earliest open year when the IRS examines you. It's always within the statute. That's your problem. It's always within the statute. You got to realize big numbers come back there. You're not safe because, this big sale took place 10 years ago. And yeah, we've deferred that gain, but that was 10 years ago. So IRS, tough luck. You didn't come in 10 years ago and say, pay tax now. So you got to wait, like we're waiting now. It's not how it works at 41A. And remember, taxpayers must, if a tax structure sounds too good to be true, the taxpayers need to exercise due diligence. They need to be very aware that they cannot take the word of any party associated with a party that has a vested interest in the taxpayer going into the transaction. Right? That was a key ruling in neonatology, right? Where they went into was it at that point a VIBA? I think it was a VIBA or VIBA related entity. It was a bunch of doctors. It was really a backdoor way to buy lots of life insurance. But the doctors never asked questions of anybody except the promoter. And they said, well, the promoter is, his attorney, whatever, etc. It doesn't matter. That is not considered to be an independent voice. You should be looking for independent advice, not advice. It's kind of like asking the car dealer, when I bought a car last year, if I go in and ask the car dealer, Toyota dealer, about, how great is this car? The Toyota cars are always going to be great in a Toyota dealer, because they aren't going to get paid unless I buy that Toyota. I'm not saying they're going to lie, but I am saying they're probably going to be a lot, let's put it this way. If I was talking to a Honda dealer, I would get a very different story, right? There's going to be a very, very different set of things emphasized. You need to make sure you're not just buying the Toyota and talking to the Toyota dealer. That's basically where it is. Or in this case, talking to the sales promoter and getting all your information from the sales promoter. That's going to be key. Make sure you do due diligence. And if you have a position that is aggressive, you should have an A275 on the return. Form A275 should be there. Because again, that gets it down to just, is there a reasonable basis for the position? And since generally you can't sign a return as a preparer if there's no reasonable basis, it makes it very, very difficult for the service to win the penalties. So you got to be aware of that in this case. If you're doing aggressive planning, you should have a 275. And I've never seen the service in all the years. I've been in practice a long time now. I've never seen the service actually go after an A275. In essence, usually the agent's just confused by it. So keep it that way. Next up, notice 2025-23, right? This is the IRS the IRS and Treasury have indicated they're going to withdraw the basis shifting, transfer of interest regulations, and related penalties. Notice 2025-23 was issued on April the 17th. So effective January 14th, 2025, new regulation 1.6011-18 identified certain partnership-related basis adjustments transactions as transactions of interest, right? TOIs, right? It triggered disclosure obligations under the 6011. So you'd have to have a disclosure form disclosing you were participating in a transaction of interest with major penalties if you didn't timely do that. You didn't go back and do it on prior returns. It will also claim that benefit. And if you were a material advisor, you had to do various reporting and disclosure under 6111 and 6112. Now, there has been a lot of criticism of these regs that they impose complex, burdensome, and retroactive disclosure obligations on ordinary business activities. In essence, you could run afoul of this without actually trying. Now, there's no question, there are people that try. Getting basis to move around the partnership is kind of the underlying structure that's used for a lot of partnership-related tax shelters. I mean, gang, that's how you play the game. But that doesn't mean that every situation where basis moves is a abusive situation. And, they're saying in a lot of just standard transactions, we're going to have to do all of this crazy reporting because there will be some basis adjustments that would look bad under these rules. What the IRS announced in this notice was they intend to publish a notice of proposed rulemaking that will remove section, regulation 1.6011-18. Now, they are doing this following a review pursuant to Executive Order 14209, one of the many executive orders issued by the new administration, since they came into office. And the proposed applicability, I'll get the word out, date of removal will correspond with the issuance date of Notice 2025-23. So basically, this week, right? That'll be the removal. So it will be there, right? The taxpayer material advisors may rely on Notice 25-23 until this notice proposed rulemaking is finalized. So until we get final regs, you can rely on the notice and ignore 1.6011-18. And retroactive application of final regulations back to January 14th, 2025, may be permitted, So that's going to be the background where they're going to allow that to go back once these get finalized. The immediate relief, the IRS is waiving the penalties related to the basis shifting transaction of interest regulations in the interest of sound tax administration, they say. Also, penalties under 6707 Cap A for failure to file the Form 8886 and report these are going to be waived. And the material advisor penalties under 6707 little a for failure to file Form 8918 and under 6708 for failure to maintain lists are also going to be waived by the IRS due to this. We're basically pulling it away. We're also going to withdraw Notice 2024-54, right? It was a basis shifting notice that came out. It had outlined the intention to publish proposed regulations addressing partnership-related basis shifting transactions, give more information on it. It was withdrawn due to stakeholder concerns. The proposed rules would be complex, burdensome, and retroactive. They were going to creating compliance costs uncertainty for ordinary business activities that were out of proportion to what they were, to the abuse that they were looking to control. And the withdrawal was also justified saying, look, under Executive Order 14219, for the president, we're going to have to pull this. That's how this works. Now, for tax practitioners, it is significant relief. You have clients who are impacted by this. If you've been worried about it, we're going to have the basis shifting transaction of interest regulations will not apply. It will relieve concerns about the complex, and this would go back quite a few years having to report this stuff, retroactive obligations on ordinary business activities. The IRS did give some relief there in the final regs, but still, you had to go back and still do a lot of retroactive work. Now, key thing here, remember, this is we're going to do something, but they haven't done the something yet. And while it would seem really wild to have some situation where they never do get this withdrawal done, right, as Yogi Berra was reported to say, it isn't over till it's over. You want to make sure this thing goes through if your client's involved with this. Keep track of this and make sure that Reg 1.6011-18 is actually stricken and gone. You can rely on those 2025-23 in the interim, basically until such time as we know, either we pull the reg, therefore, right, we don't need to worry about it all, or if some reason that they decide not to pull the reg, if that were to happen somehow, then you would suddenly have to start reporting again once we got to that date. So that's why you keep it in mind. Finally, it's been a long time since I've talked about a hobby horse case, and we have a horse case here today. This is both a hobby loss and a failure to file. This is the case of Himmel v. Commissioner. This is Tax Court Memo 2025-35, and the decision came down on April the 17th. So what's the background of this case? Well, these two, husband and wife, they engaged in Arabian horse activity called Plantation Arabians since 1981. So they've been going at this for a while. They're reporting losses since at least 1993. Yeah, they don't have records going back further than that. So they know at least since 1993, they have lost money on this thing essentially every year. Now, the IRS was auditing the 2004 to 2009 returns, right? All of which were filed late. And the IRS went after the deductions under Section 183. That's what's called informally. The code section itself doesn't call it this, but we all informally call this the hobby loss rules. Now, the 183 rules are nasty because if you have, it limits your deductions to the amount of gross income. But what's nastier, which we talked about, I think about a year and a half ago, is those deductions are not trade or business deductions. They're rather miscellaneous itemized deductions, which, of course, now with the TCJA, you're not going to get those at all. But even before the TCJA, miscellaneous itemized deductions were non-deductible for purposes of the AMT. So it can be really bad if you have an activity with a lot of income going into it, but that has hugely more expenses. Yeah, 183 can be a real disaster. So always keep that in mind. In the case we talked about, it was about a year ago or so, that was a case involving a yacht. Yeah, they got a lot of money for renting the yacht, but they spent a whole lot more. And that became a problem. Now, the IRS had conceded accuracy-related penalties before trial. Don't know why, but they're not arguing for those right now. So the remaining issue was, did they have a profit objective? Or did 183, under 183A, did they meet the profit objective requirement there to not have it yanked in under the hobby loss rules? And was there a penalty for failure to timely file the returns under 6651A1? Because while the IRS was not asserting negligence, they did note that these guys didn't file these returns on time. They're going to go for failure to file. Let's talk about 183, an activity not engaged in for profit, which is the actual title of the section, not hobby loss rules, okay? General rule is you can deduct losses if an activity is a trade or business or for the production of income under section 162 and 212, right? Now, you might say, well, 212 expenses are also disallowed below the line. Not all of them. A rental doesn't rise to a trade or business is technically a 212 activity, right? So there are those royalties come in the same category. So understand that. But yeah, those will give you a loss. So if you got that, if it's truly a trade or business or truly an activity entered into for production of income, you basically can take the loss deduction, assuming that there are deductible expenses, otherwise deductible expenses that would get it. But 183 limits those deductions if the activity is not engaged in for a profit. It limits those deductions to no more than your gross income, and they're not trade or business deduction under 162, which means the way the code's structured, this is when you have to kind of walk through how the code's structured, but by default, every deduction the code allows to an individual is a miscellaneous itemized deduction unless you can find a way to shift it somewhere. To shift it above the line, which is the best option, right? So it enters into calculation of AGI, or at least shift it to be an itemized deduction that's not a miscellaneous itemized deduction. Find a way to yank it there. And as we know, we had the ruling a couple of years ago, or a year ago or so, that, yeah, these 183B expenses, which is what they come out because that's the section that allows deduction. Yeah, they're miscellaneous itemized deductions. So yeah, we have a real problem with it. Now, to determine if there is a profit motive, right? So do we have a trade or business? We look at 9 factors under Treasury Regulations 1.183-2B. Now, I do believe I think it was the Seventh Circuit a couple of years ago that said, this is all a joke, right? We're not really told what to do with these. It's like, it's crazy. They went ahead and did a separate analysis on their own. So yeah, in the Seventh Circuit, as I recall, they did kind of ignore this, but everybody else still does. The tax court always going to mention this. And these are somewhat important, even in the Seventh Circuit. These sorts of questions still came up. Number one, did you manage the activity in a business-like fashion? And the court found in this case, the answer was no, right? The Arabian horse activity, which, by the way, they only sold, I think it was one horse in the period under exam. One Arabian horse was sold in that like 5 years under exam. And, it was sold for $14,000, which was less than they paid for it. It's like, yeah, it's horrible. Yeah, they didn't make money. So they commingled funds. Nothing says under the law you can't commingle funds, right? But generally, if you're going to run a business, it's going to be way easier to track things, way easier to analyze stuff if you don't commingle your funds. You treat it as separate. They had no cost tracking that they were doing, right? They weren't producing the information necessary to be able to evaluate this activity and make changes on the fly. And they never changed their operations, right? From at least the 93 period, we know the losses, when we know we have losses from them, all the way through 2009, they kept doing it exactly the same way. These argue against this being a trade or business because the taxpayer operating a trade or business would operate, in a way that they control it, they would be learning, and they would consider making changes when it's not working, they're not getting money in. What's the expertise of the taxpayer or their advisors? Now, both the husband and the wife did have experience working with Arabian horses in various ways. And so they knew that part of the background, but there was no credible expert business advice about how to run a profitable, Arabian horse breeding business and do that kind of background. And none of that was ever brought in. They ever brought anybody in for that. So while they knew basically how to do that part, how to make a business work, they never actually consulted with people in that range. So the court found that that was neutral. Time and effort spent by the taxpayers, they found that they spent a lot of time in this. And that a lot of time actually goes to saying, hey, what looks more like a business, right? So that was in their favor. Did they have an expectation that assets used in the activity may appreciate? The court says this is going to go against the taxpayer because there was no evidence whatsoever that you could expect these horses to appreciate. And certainly their history suggested it hadn't happened. They're saying there's nothing there that really shows why they would, why they would reasonably believe that. Did they have a success in carrying on other similar or dissimilar activities? This went against the taxpayers because they had 2 other horse ventures over the years, both of which were unsuccessful. So now they're going to come back and keep doing the same thing. Yeah. Now, that doesn't sound like business, working a business normally. Did they have a history of income or loss with respect to activity? Long history, only losses. Again, if you're operating a business and it keeps losing money, you're probably going to rationally shut it down. If in fact, unless you're not really caring about running it as a business. And that was the position the court said that leaned that way. Did they have any, how much was the amount of occasional profits earned? Maybe they lose money most years, but they make big amounts of money every so often. And the court found that there was no substantial profits ever in this business, at least all the way back to 93. So they're saying that goes against the taxpayer. Now, I'll be honest, this one is probably the big one that will tell you most times if your client has any shot at all. What is the financial status of the taxpayer? And what this really looks at is, if you've got somebody here who they are about to file bankruptcy because if this business doesn't work, they're going to be totally destitute. That's probably going to find that it's a business. They're just stupid, for not figuring out they're losing money, but they really were running a business. However, if you have substantial income from other sources, and they did, right, from various sources, his family business, he would have been involved in it. He's getting a big salary from it, right? He got all kinds of stuff there. They had lots of rentals, So all that background, they had significant income from both, his salary and the rentals and things they own. And these losses from the horse activity obviously helped reduce the taxes there. Yeah, they got substantial tax benefits and they had other income sources. So they were not at risk of losing everything because this business didn't make money. Yeah, the court found that goes against the taxpayers. And were there elements of personal pleasure or recreation? Horses. You know what? Yeah, that's the problem. That sounds like an enjoyable activity. I'm sure that if you're in the tax season, some of you believe that doing tax work is not enjoyable, right? Very, very few people would probably say that qualifies as oh yeah, I just would love to do nothing more. I'd do it for free, right? I just need to be able to lose money constantly. No, I think most of us would say doing tax work doesn't fall in that category. But in this case, they had always been around horses. They had owned horses all their life. They loved working with horses. There was a lot of personal pleasure. Overwhelmingly, these factors went against treating this as a trade or business. In fact, 7 of the 9 factors were weighed against the taxpayers. So the court concluded that they did not have an actual and honest objective to operate plantation Arabians for a profit during the years under exam 2004-2009. The court fully sustained the IRS's disallowance of loss deductions in those years. All of that was gone. Now, unrelated, it turns out that every one of these returns had been filed late, after the extended due date, right? Now, the penalty for filing late applies unless it was due to reasonable cause and not willful neglect. Well, all the IRS has to show for the burden to shift to the taxpayer is that the returns were filed late. IRS produced evidence of that. The taxpayers didn't disagree. They were all filed late. So now the burden is on the taxpayers to avoid the failure to file penalties, right? Which is going to basically be 25%, right, of all of these unpaid taxes will be in there. So yeah, it's going to be bad. Reasonable cause requires showing that you exercise ordinary business care and prudence, and you still essentially were unable to file timely. Right? It's their burden to show that. Now, in this case, the courts didn't buy it. They started down an area that either one of which could have worked, but you got to connect the dots. They pointed out that they worked with CPAs and tax attorneys on their tax matters. And Mrs. Himmel was actually taking care of her father for many years, had significant caregiving requirements. But they never did tell us why either one of those things meant they got delayed. Like, did the attorneys and CPAs somehow, tell you didn't need to file or do something else that got it wrong? How in the world did you, let's face it, those of you here listening today, I would suspect that 99.9% of your clients, unless you're in collections areas, that's your specialty, probably filed on time, over the last 5 years. Been very rare to have somebody file late. So the norm is, you'd file on time. They didn't explain why something that the attorneys or CPAs had done was responsible for them being unable to file on time. Now, secondly, yes, her having to take care of her, elderly father who was in very poor health, that might work, but you have to show why you couldn't get the returns filed. Especially since you just told me that you hired outside accounting firm, outside attorneys to help you with this. Why were you unable? Because the court pointed out you were still able to take care of the horses and get all that stuff done, Mr. and Mrs. Himmel. So if you claim that you had all of these major responsibilities, but you're still doing all the other business activities you would normally do, the court's not going to accept your reasonable cause. They don't say it's there. A selective inability to meet tax obligations, that's a term used, which means you met all the other obligations, but you just didn't do the taxes. That suggests more you just didn't want to do the taxes, and that's not an excuse, right? If you had seriously been unable, the company had gone, your let's say your business, his family's business gone under because he couldn't, he was unable to do things, whatever. Somehow you could show that it did other stuff, but the magic that it only affected your inability to file tax returns, yeah, you're not getting the relief for failure to file. Court applies, failure to file penalty, applies to all of this. Key conclusions, just bottom line, they did not engage in horse activity for profit, and they had no reasonable cause for not filing on time. So they're going to get the penalties. Right? So a few things to take from this case. If you have somebody in an activity that is pleasurable, that's really important, and they have significant income, so they don't need to think to make a profit, you need to look at all 9 factors objectively. And you're going to lose that one that they don't need to make money. You're going to lose the fact it's enjoyable. But if you can carry the other 7, those 2 aren't a problem. But you got to start realistically looking at it. As an outside observer, your job, yes, we advocate for our clients. But you advocate for your clients based on a realistic evaluation of what's possible. Your job is not to just tell them everything's great and rosy, right? Sometimes you got to tell them the truth, right? Your situation is horrid, and you're probably going to lose if you keep going. In fact, it's so bad, I don't see a reasonable basis for claiming a loss, and so I'm just going to have to resign the engagement. Remember, we can't sign the return if we can at least get, reasonable basis for the position. And if the facts are really bad, there doesn't appear any way to make the facts reconcile with the business, you got to bail, right? Don't erroneously equate being an advocate for your client with being willfully blind to the fact that they got no shot whatsoever. You do the client way more favors by telling them you've got no shot whatsoever. These guys really had no shot, right? That was it. Make sure your clients who are operating a business that's, that it may be challenged in this area, from day one, have formal business plans, have detailed records focused on profitability, and adapt their operation. If you're losing money, don't keep doing the same thing. Find a new something to do. Find a way to change things up, to try to make things, to attempt to become profitable. Make sure also that, you seek expertise and advice. When you do so, document that. Where'd you go outside, especially if it's not working, did you get experts to try to help you work through things, try to figure out what's going on? If you're going to claim that your assets are going up, like these horses are going to go up in value, you got to have credible evidence of fair value, right? And that there's reasonable expectation of appreciation, which means probably showing past appreciation. You got to have that evidence. They had none. Also, timely filing, their second problem. Yeah, it's very difficult to get out of a failure to file. Failure to file, you will get out of it the one time, right? For basically because you've not had a problem the prior 3 years. So the first time abatement with that administrative process, that's probably the way to most often get out of it. Otherwise, it's really difficult. You need a really good reason to show both why you couldn't file on time, right? And also why you had taken, and that meant you'd also taken every reasonable step to do so. Just merely saying, oh, I was sick, or, whatever, or I had experts, I had outside people working with me. That doesn't work. That's all they told us. Yeah, life's tough, but, people with tough lives, a lot of them still filed their tax returns on time. So why didn't you, if you don't have a reason, right? And really, the key issues here, you got to be realistic with clients about the profit motive rule. You got to be realistic. Come on, they've been showing losses probably since 81. you got to say, guys, time to get real. I always have that discussion when they go on a few years with this business they started and it's losing money and nothing seems to be changing. We got to have a discussion saying, guys, you need to understand that you need to fix this, right? This is waiting for somebody to throw out. And eventually I've got to say, I can't do the return anymore. You got to kind of be there. That's not being nasty to the client. That's not failing to, basically advocate for their position. What it is simply lying to the client. And lying to the client's not a good thing. They need to get the truth, even if they don't want to hear the truth. That's the key thing you should be doing. This has been the current federal tax developments for the week of April the 21st, 2025. As always, this is brought to you by your state society of CPAs. I will be monitoring the Connect groups for Arizona, New Jersey, Minnesota, Idaho, Illinois, Washington, looking at those places. If you have questions, pop them up there. And if I see something I think I could help with, I'll try to answer. Otherwise, we will see you probably next week. We should, no problem, no delays this time. If you have questions, you can send me an email, edzollers@currentfederaltaxdevelopments.com. Is a place to go. Remember, currentfederaltaxdevelopments.com is also where we post these stories during the week as things happen. So you want to go look there too for updates. You can sign up for the mailing list there as well. I know we used to have a mailing list, but we had to transition over and do a few other things. So yeah, if you want to get back on the mailing list, you go back in and sign up again. It should work, no problem now. But otherwise, I look forward to seeing you guys or having you guys here watching this next week when we talk about additional current federal tax developments.